Okay, imagine this. You've spent, I don't know, hours, maybe days, building what looks like the perfect trading strategy. On your screen, that equity curved line showing the profit, it's just shooting straight up. Drawdowns as little dips are tiny. You're already thinking about the profits, right? But then, uh-oh. You put it on a demo account, maybe even live, and bam, within a week, it's losing money. Does that sound familiar? Yeah, I thought so. That jump, that really frustrating leap from a perfect backtest to, well, real world failure. It's incredibly common. So today we're doing a deep dive into exactly why that happens. We've looked at some really great source material, insights around tools like StrategyQuant X too. And we're going to unpack the 5 biggest, most common mistakes people make building these strategies. And more importantly, show you how to actually avoid them.
It's fascinating, isn't it, how often these traps come from just a few predictable blind spots. Our mission here, really, in this deep dive, is to not just point out the pitfalls, but give you a clearer roadmap. We want to help you build strategies that have a genuine shot in, today's dynamic markets. It's not just fiddling with settings. It's more about a fundamental shift in how you approach building these systems, moving from, let's say, hope to grounded realism.
Yeah, absolutely.
Yeah.
So for you listening, whether you're really deep into automated trading already, maybe using sophisticated tools, or perhaps you're just super curious about how complex systems get built and tested, this deep dive, it's going to be a shortcut. You'll get that crucial difference between like theory and what actually holds up in the real world, robustness. We want to equip you with the knowledge to spot these common flaws, focus on what really counts for performance, and end of the day, save you time, frustration, and resources.
And that's crucial because time is, well, it's often the biggest resource we're trying to protect here.
Okay, so let's jump right into the first critical pitfall. This one feels kind of obvious sometimes, but it's so widely underestimated. It's using too little data or maybe just one single data set. You run your generator, you test on maybe the last year or 2 years of market data. It looks amazing, right? That equity curve is just beautiful. You feel like, yes, I've cracked it.
Mm-hmm.
But what's actually going on under the hood there?
Well, that initial perfection, it's often just an illusion, a kind of mirage based on a really narrow slice of reality. See, when you test on limited data, your strategy has only ever experienced one specific type of market weather, so to speak. Think of it like a student who only studied chapter 1 but now has to take the final exam covering everything. It's not going to go well. The market, it's always changing. Sometimes it's a raging bull, sometimes it's flat ranging, sometimes volatility just explodes, like 2008 or the crazy shifts we saw with COVID. If your strategy hasn't seen that full spectrum, the rallies, the crashes, the quiet times, it's built on, well, shaky ground.
Right. It's like testing your house foundations, but only on calm, sunny days.
Exactly.
The first big storm hits and boom, it crumbles. Our sources really hammer this home. The fix is straightforward, but people skip it. Always use long histories. We're talking ideally 10, maybe 20 years if you can get it.
Okay.
And then not just on one market, right?
Yeah.
Or one time frame. You need to test it across different things, different periods. It's about giving this strategy the full exam, the comprehensive one, not just, one easy question.
Precisely. A system that holds up over, say, 2 decades. It's proven something. It's lived through multiple economic cycles, recessions, booms, sentiment shifts, global shocks. Each of those periods had unique market behavior. So a strategy that can navigate all of that, it has a much higher chance of surviving whatever the next market environment is, much better than one just optimized for that recent bull run it happened to see. It gives you a much deeper understanding of its real behavior, its adaptability.
That makes total sense. But it does make me wonder, if the market is always changing, are we ever really done? And like adding data, is there a point where, maybe going back too far gives diminishing returns beyond, say, 20 years?
That's a really good point. Generally, more data is better for checking robustness, definitely. But yeah, there can be a point where really old data from maybe completely different market structures or, technological eras might become less relevant. The goal isn't just sheer quantity, it's also relevance and diversity of conditions. So aiming for 2 decades is a solid baseline, but always think about the specific instrument, the historical context. Sometimes focusing on diverse types of market conditions within a significant time frame, like the last 15, 20 years, is more valuable than just tacking on another 50 years of potentially outdated data.
Okay, gotcha. Relevance and diversity, not just length. That idea of the perfect backtest, maybe on thin data, leads nicely into our second pitfall, ignoring robustness. This is another one of those subtle traps. It makes strategy look amazing on paper, but then it just face plants in live trading. Our sources had a good analogy. Falling in love with a flawless backtest is like seeing a bodybuilder on Instagram. Perfect light, perfect angle. But in real life, when they're actually, say, lifting something heavy, the picture might not be quite so flattering.
Exactly that. So how do we really test its strength? Beyond that perfect Instagram shot, we need to ask, how much pressure can this thing really take? A perfect backtest often screams curve fitting. It's over-optimized. Basically, you've made the strategy fit the past data so perfectly it includes all the random noise, not just a genuine market edge. And then, of course, it fails on new data it hasn't seen. If you skip the critical robustness tests, things like Monte Carlo simulations where you randomly shuffle trades or tweak parameters to see if the results hold up, or walk forward analysis, which tests it on sequential blocks of unseen data, if you skip those, you're only seeing that perfect posed photo. You're not seeing how it performs if things are just slightly different. A bit of slippage, a different trade order.
Oh, I've definitely done that. Stared at a smooth as silk equity curve thinking, this is it. And then reality hits. It just blows up. So what's the takeaway for someone trying to build something truly reliable? Our sources are crystal clear. You have to stress test it. You have to, shake it vigorously. If it still looks decent under that kind of pressure, then maybe you've got something real. This means testing with realistic cost, maybe slightly worse parameters, really embracing those robustness checks. Don't just admire the pretty picture. Dig deeper.
Robustness testing is it's your essential reality check. It forces you to face the imperfections. It prepares you for the unavoidable bumps and variations of live trading. You're trying to break it in testing, basically, so it doesn't break you later in the live market. It builds confidence, not in one perfect outcome, but in a range of acceptable, durable ones. You want something that bends, but doesn't snap.
Okay, next up, mistake number 3. This one often feels a bit backwards. Overcomplicating the rules. I read this cautionary tale in our source material about a strategy with, 10 different indicators, multiple conditions layered on top. The logic was so complex it looked like a crazy flowchart, almost like trying to fly a plane with 5 steering wheels and 3 brake pedals. You're fiddling constantly, but you have no idea what's actually working. And the result? Curve fitting. Again, at its absolute finest.
That analogy is perfect. It really captures the trap. There's this human bias, isn't there? Believing complexity means sophistication or maybe strength. We think, oh, more rules, more indicators must be smarter. But in automated trading, it often works the other way. The more conditions you pile on, the more you're just fitting noise and specific historical quirks. You're not capturing a genuine, repeatable edge. You end up creating this bespoke suit, tailored perfectly for yesterday's data, but it just won't fit tomorrow's market. It won't generalize.
It really is less is more, isn't it? The truth, based on everything we looked at, seems to be that the best strategies are often quite simple. Maybe 1 or 2 core conditions, logical, easy to grasp, and here's the key: robust. They work across different markets, different data sets. Complexity often just equals fragility. You want clear, decisive rules that tap into some fundamental market behavior, not this sprawling mess of ifs and thens that only worked by chance in the past. But how do you even start simplifying if you've already built one of these complex monsters?
A great way to start is just take things out, remove every rule, every indicator one by one, and watch what happens. Does the core performance actually suffer? You'll often find many rules were just adding noise, not signal. Zero in on the absolute minimum needed to express that core edge. If the underlying edge is real, it should be visible with relatively simple logic, and that's simplicity. It doesn't just boost robustness. It makes it way easier to understand why your strategy is winning or losing. That lets you make smarter adjustments when, inevitably, conditions change. It's about finding clarity, really.
Finding clarity in the chaos. I like that. Okay, mistake number 4, wrong broker or data settings. This one can be a silent killer. It's often totally outside the strategy logic itself. Oh man, this one hits home for me. I remember building what I thought was this brilliant short-term scalping strategy. Look amazing in the backtest. Then I realized my actual broker's spread. That tiny gap between the buy and sell price measured in pips, it just completely wiped out all the theoretical profit. Every single trade, it was a harsh lesson. Aligning theory with the gritty reality. You might build this genius strategy, then watch it die instantly live. Why does that happen so often?
You absolutely nailed it. It's amazing how often these basic foundational details get overlooked. Your backtest might assume, say, a 0 or near 0 spread, but your broker, They charge 2 pips, maybe more on volatile pairs. That's huge for a scalper. Or maybe forget about commissions. Or you don't account for your broker's specific GMT time zone setting. That can totally throw off your entry and exit timing between the backtest and live trading. It's exactly like you said, training for a marathon at sea level, then trying to run it up a mountain. The reality of the trading environment, the costs, the timing nuances can be completely different from your simulation. If your backtest doesn't mirror those real-world frictions, your strategy is basically built on sand, ready to get washed away by actual trading costs.
And the fix. Thankfully, it's relatively simple, but it's absolutely crucial, non-negotiable. You have to set up the right broker profile in your testing software, like StrategyQuant X or whatever you're using. That means meticulously matching the spread, the commissions, the trading hours, rollover fees, slippage assumptions, everything. Match it to your actual live broker. Get trained for the mountain if you're going to race on the mountain, right? There's just no point having a brilliant strategy if the costs eat it all before it even gets going.
It's all about alignment, aligning the theoretical model with the practical reality. These seemingly tiny differences in costs or timing, they can completely kill a strategy that otherwise looked profitable on paper. It's not just about what the strategy logic does, it's how it interacts with the real financial plumbing. Ignoring this, well, it's like designing a perfect car engine but forgetting to put gas in the tank. Looks great, sounds great maybe, but it just won't run.
Perfect analogy. Okay, and finally, mistake number 5. This is a big mindset one that so many traders fall into. Chasing the holy grail. You know, that belief that if you just keep tweaking, keep generating, keep running those strategy builders long enough, eventually you'll find it. That magical equity curve that only ever goes up, never loses. The one perfect system to make you rich forever.
Oh yeah, that belief. It's possibly the single biggest mindset trap in this whole game. The hard truth, and it's emphasized everywhere in the material we looked at, is simply this. There is no holy grail. It doesn't exist. One strategy will never be enough to consistently handle all market conditions. Relying on a single, supposedly perfect system is just a recipe for eventual disappointment because markets change, they evolve, and every single strategy has conditions where it shines and conditions where it really struggles. Put simply, no one trading strategy can be all things to all markets all the time. It's just not possible.
So if there's no single perfect system, what does that mean for building something truly resilient? How do you approach it? The fix, according to the experts, is to stop looking for perfection in one system and start thinking more like an investor. Like building a portfolio. Build a portfolio of strategies. Diversify, maybe across different instruments, some forex, some indices, maybe commodities. Diversify across time frames too, some short-term scalpers, some longer-term trend followers, and diversify across different types of logic, maybe one trend strategy, one mean reversion strategy. That way, if one system hits a rough patch because the market conditions aren't right for it, the others can potentially carry you through. It creates a more stable, robust portfolio edge overall.
Precisely. It's about embracing the reality of dynamic, ever-changing markets. Real stability, real long-term success. It comes from diversification, not from chasing some elusive single perfect solution. You're building a collective strength. The weaknesses of one strategy get offset by the strengths of another. That creates a much more robust, much more sustainable trading operation. It's about achieving a cumulative advantage over time rather than relying on a single flash of brilliance. It ensures your whole trading business can actually weather whatever storm comes along.
So we've just walked through 5 pretty critical pitfalls, haven't we? Things that can really derail even the most promising automated trading strategies. We covered the dangers of using too little data, ignoring robustness testing, the trap of overcomplicating the rules, mismatching your broker settings, and that big one, chasing the elusive holy grail. We've seen how easily that initial excitement can just fizzle out into real-world disappointment if these mistakes aren't really tackled head-on with rigorous thinking and testing.
Yeah, and the powerful lesson that really comes through from all the sources we looked at is pretty clear. Real-world performance. It demands real-world rigor. And maybe even more importantly, a fundamental shift in perspective. There isn't some magical, never-losing system just waiting out there. Instead, the true strength, the real edge, it comes from thinking like a strategic investor. Building that diversified portfolio of robust strategies. Strategies that can collectively handle different market conditions. Rather than pinning all your hopes on just one perfect system, it's about building a trading business, really, not just finding a single golden ticket.
Ultimately, as the insights we've shared remind us, powerful tools like StrategyQuant X, they aren't just about generating systems like hitting a button. They're tools to help you build something that genuinely works in the future, something that can adapt, persist, and perform robustly over time. So what does all this mean for you, the listener? maybe even beyond the world of trading?
Well, it raises an interesting question, doesn't it? Consider this. Where else in your own life, maybe personal or professional, might you be looking for a holy grail? That one perfect, all-encompassing solution, when maybe, just maybe, the true strength lies in a more diversified approach, or in rigorously stress testing your assumptions, embracing a more realistic, more robust mindset. What areas could benefit from you, sort of shaking them a bit, or expanding your data set beyond your usual comfort zone, or maybe building a portfolio of approaches to really prepare for whatever changes might be coming?